Hello, my name is Patrick Yankee with Yankee Financial in Raleigh, North Carolina, securities offered through Raymond James Financial Services. Welcome to this quarter's Capital Markets Review. As always, my purpose is to inform and to answer questions on the economy and the financial markets. This isn't meant to be my prediction for the course of the stock market for 2020 and beyond. Rather, it's a review of economic and historical data to help investors make informed decisions about their financial futures. Once again this quarter, I have chosen to use slides from the Guide to the Markets produced by J.P. Morgan Asset Management for the simple way they present complex ideas. There are also a couple from ClearBridge as well. Most slides have multiple charts on them. I'll point out the information I think is most relevant. J.P. Morgan and ClearBridge are not affiliated with Raymond James. The opinions expressed are mine and not necessarily those of Raymond James. This quarter, there are four main themes I want to discuss. Recession risks are rising. Interest rates expectations, and an update on where we are, equity market assumptions, and then what investors should do. Third quarter GDP was just above 2% annualized over the same period of the prior year. Economists forecasted this slowing and see this level of economic expansion continuing for the foreseeable future. The risk of recession is growing compared to recent years. However, consumer spending, over two-thirds of economic activity, remains strong. The weaker area is in investment spending. All consumers aren't created equally, though. The last 50 years has seen a dramatic increase in the share of income going to the top 10% of earners. What's interesting about that statistic is how much of that income is ultimately circulated in the economy. The top 10% tends to only spend about two-thirds of their income, while the bottom 90% spends as much as they make or even more. This higher concentration of income may manifest as dampened economic activity and greater investment returns. Much of that excess income is in savings and investments. The slowdown is primarily in areas greatly affected by uncertainty and the clouds hanging over international trade, largely due to tariff talk, and that may be a major factor here. Businesses tend to get cautious when the playing field is changing. Looking at consumers and businesses directly, we see that these cyclical sectors are not currently forecasting recession. These areas are mean reverting. This means that higher than average numbers in prior quarters may be met with lower numbers in subsequent quarters. The fact that residential investment in motor vehicles have not yet returned to long-term averages should help with continued growth. Inflation remains fairly tame by historical standards. It has held fairly steady for over 20 years. One reason for subdued inflation is below-average wage growth. That is changing as the constrained labor market is now driving wages higher. Higher wages tend to portend higher future inflation. An interesting note about business investment and the market cycle. See the left chart here. Based on the headlines, you would expect that businesses lay off a large number of workers when anticipating a recession. That isn't the case, though. They tend to freeze hiring when they anticipate recession. The layoffs come after the recession has already begun, and to a much lower magnitude than the hiring freeze. As the recession ends, layoffs are curtailed and hiring resumes. In this market cycle so far, hiring remains strong, although it is tapering its upward momentum. The dollar was expected to weaken last year, but it actually strengthened until the end. By the end of the year, it was virtually flat overall. This means overseas investments didn't have the headwind they experienced over recent years, and that was good for American investors. The price of oil can be a significant drag on our economy when it rises significantly. American production has been largely responsible for global production keeping pace with consumption. In fact, economists are forecasting a surplus of oil production for the foreseeable future. A price of oil above $50 a barrel allows American shale oil producers to produce oil for a profit, not so much below the $50 level. American producers are helping to keep the price of oil in check globally. What's interesting about this chart is that the price of oil remains fairly tame even after the attack on Saudi Arabia's oil production and recent tensions with Iran. Energy independence for the world's strongest economy is helping global stability. Looking at global manufacturing, we can see that there is quite a bit more orange and red on this chart than previous quarters. What's interesting is that the weakest areas are those that depend on exports, likely hurting from tariff discussions. Take a look at Germany and the Euro area in general, Mexico, and Russia. Resolution in the North Atlantic and the recent Phase 1 agreement with China should help overall. The Eurozone will probably keep their headwinds for now as they work through Brexit. They are also a likely future target for trade negotiations. The weaker areas of the previous chart are the ones on this chart with exports as a significant share of GDP. At only 8% of GDP, the US is actually somewhat insulated from this situation and in the best bargaining position for adjusting barriers to trade with trading partners. World trade volume was affected by rising tariffs and tensions. Those areas hurting the most by recent trade negotiations may be the ones who benefit the most from resolution. Most of the weakness has been overseas. US earnings growth remains strong. Where to find value overseas? Most developed markets are over their long-term historical valuations. There is some value in Japan and emerging markets for those looking for more attractive valuations. Last year was a banner year for equity investors. Domestic investors saw gains over 30% on average, and overseas investors saw strong gains as well. Changing currency values didn't hurt overseas investors as much this year as they had in past. When markets are low, all it takes is the courage to invest. When markets mature, it's important to rely on experience and knowledge in this environment. When trying to forecast the next recession, I think this summary chart from ClearBridge tells a compelling story. They developed this information from looking at prior recessions and making relevant comparisons in the main areas of economic activity. Although there are some areas of caution in the economy, we are generally not on the verge of recession based on historical comparisons. For comparison's sake, this is how the chart looked for prior recessions. Generally, we would be much more cautious now if consumers were weak. This is how the recession dashboard progressed in the last recession. If we had had this tool then, it would have sounded a compelling warning. As I've said before, economic expansions don't die of old age. Although our current economic expansion is historic for our economy, consider that Australia's current expansion began nearly 30 years ago. You don't have to assume the economy is headed south just based on the time it's been growing. Let's talk about interest rates. The recent movement in interest rates has been down. Currently, investors in the 10-year Treasury are realizing a negative yield relative to inflation. At these levels, fixed income is better used in a portfolio as a hedge against equity volatility than as an actual income vehicle. Yields across the debt markets are at historic lows. There isn't much income to be had through yield. When interest rates rise to create more income, value will be lost. Investors may be wise to use bonds as a hedge against equity volatility, but they won't find much income or long-term growth potential at these levels. Stretching for yield can prove to be problematic for investors. The greater the yield in this environment, the greater correlation to equities. In other words, those who invest in bonds as a hedge to equity volatility may experience equity level volatility in their bonds by reaching for too much yield in this environment. The Fed has cut rates from recent highs. This is an acknowledgement that rates moved too high too fast. They are currently signaling a pause in rate movements. There are two reasons. One, they want to see how the economy reacts going forward before making their next move. And two, they aren't likely to move rates in an election year without significant reason to avoid political fallout. Bottom line, expect the Fed to hold the line this year. One of our long-term risks is government debt. Currently, paying interest is about 8% of the federal budget, borrowing about 22 cents for every dollar spent. As more debt is accumulated and interest rates rise, the cost to carry the debt will increase. Although it's manageable now, sooner or later the government must show some financial responsibility. The dangers are considered to be far in the future still, but it is a long-term danger. Notice in the bottom right that federal debts are expected to increase their rate of growth, and that's not a good trend. See the bottom left chart for CBO expectations for the economy. For this year, the CBO expects GDP to grow by about 2.2%. Going forward, they see growth rates slowing back to sub 2% levels. They expect Treasury yields and inflation to remain tame, and the expectation that unemployment will rise may be premature, as JP Morgan is forecasting an even lower rate than currently this year. It's important to note that the CBO isn't anticipating a recession. It's simply an expectation for the rate of growth to decrease. The left chart here shows a representation of debts relative to GDP. Household debt has come down significantly since the last recession, as consumers have either used bankruptcy to retire debt or become overall more debt averse. Corporations have taken on more debt as it is advantageous in a low interest rate environment. Governments at all levels tell a much different story. In the last 40 years, government debt has gone from around 1/3 of GDP to 100% of GDP, much of it in the last 10 years. and this is while GDP was expanding to record highs. We have a government debt problem that must eventually be solved. Quantitative easing has returned. The Fed and other central bankers around the world had been on a program of reducing their balance sheets. That has now given way to more asset purchases. As long as the federal government needs buyers for the debt it issues, the Fed will remain the buyer of last resort. This means they will continue buying as long as there isn't enough market participation for the full issue. Let's talk about the equity markets. Between March 9, 2009 and the end of 2019, the S&P 500 increased by 378%, excluding dividends. Those with a short-term view of history would be forgiven for seeing a market peak at these levels. Consider, though, that we've been through what's known as a secular bear market. There are really two phases when evaluating PE ratios: the secular bear, where PE ratios are contracting, and the secular bull, where PE ratios are expanding. The only way you know you've gone from one to the other is in hindsight. Through the recent secular bear, forward PE ratios contracted from 27.2 times earnings to their current level of 18.2, up from 16.8 last quarter. The yield on the S&P 500 is equal to the 10-year Treasury. This chart shows secular bulls and bears. The secular bear markets are noted by the horizontal lines. It's normal that the market moves to new highs after lows in the PE ratio. It is somewhat cyclical. The average secular bear is 14 years long, and the most recent started in March of 2000. Is it over? Only time will answer that question. However, strong market performance shouldn't deter stock investors with a broad view of history. We seem to have broken out of the recent bands of market performance, but that doesn't guarantee a future without significant volatility. Equity valuations depend on both the price of stocks and the earnings of the companies underlying the indices. The PE ratio is climbing, and that will likely mute future returns. Investors will have to be patient in this environment and not expect returns greater than 25% every year. In order for the markets to move forward without increasing the PE ratio, equity prices must keep pace with earnings. The forecast for earnings is to increase by about 5 to 7% this year. Raymond James sees three cases likely for this year. The case for a strong market may see growth around 12%. It isn't the most likely scenario. Their base case, most likely, is about 4% asset growth, and we've nearly reached this target already. The least likely scenario is a drop similar to the fourth quarter of 2018, or about 18% drop. Wherever we end the year, we will likely see significant volatility this year due to high asset values and election uncertainty. Higher equity values suggest this is an environment for strong security and sector selection. I favor sectors with lower PE ratios relative to historical valuations. Financials, energy, and healthcare are strong sectors for the long term. Domestic investors will find greater value overseas. It may take patience, but there is a lot of room for growth outside of our borders. So what should investors do? It takes courage to invest. Even though the market finished positive 75% of the years in the last 40, the average year saw an intra-year decline of almost 14%. Those who would invest in equities should focus on their financial goals and not react emotionally to every market move. Complacency may become a significant factor as investors haven't experienced historical market volatility for a while. When the markets become volatile, it can be stressful, and investors who only recently began investing may react emotionally. Note that even when the market doesn't finish positively, it never finishes on its low. Selling into a panic isn't a good strategy for wealth preservation nor long-term growth. We would all love to be able to invest without risk. If I offered someone an investment which would have an average return around 7% per year, most people would jump at it. That's what the red line represents. What it really represents, though, is the average annual return of the S&P 500 for the 20 years ended with the bottom of the fiscal crisis, or the end of February 2009. As painful as the market felt in the dot-com bust of 2000 to 2002 and the fiscal crisis of 2008 to 2009, the returns for the long-term investor were still fairly robust, even at the worst of it. By the way, why do you invest rather than taking a guaranteed 7% over the long term? This chart shows what happened since the bottom of the S&P 500 to now. Guaranteed returns look good in the worst of times. Over the long term, they create more financial opportunity loss in the portfolio than the short-term volatility of the markets. In this mathematical example, it would take a loss of greater than 50% in the S&P 500 to return to the 7% average line. 2018 is just a small blip at the end. Note also that the great gains of last year were largely a rebound off of a horrible end of 2018. Keep in mind that the S&P 500 is an unmanaged index. It's not possible to invest directly in the index. Past performance is no guarantee of future results. Some successful money managers may have seen even better results. Consider your asset mix. I'd like to show this chart to demonstrate volatility. Those asset classes which rise the most also fall the most. Another lesson is not to chase returns. What led in growth one year is not guaranteed to lead the next year. In fact, oftentimes the leaders move to the bottom of the class. Maintaining a diversified portfolio has generally worked for the long term. What's on top doesn't stay there, and what's on the bottom will move up again eventually. Volatile asset classes will usually be found at one of the extremes. Asset allocation can help make growth a smoother ride for investors. There's another story here. Up until 2008, a diversified portfolio beat the S&P 500 index 5 out of 7 years. Since then, the diversified portfolio has underperformed the S&P 500 in every year. This can cause investors to put aside diversification in favor of unmanaged indices. Despite recent experience, diversification is still important. The low volatility of recent markets was an ideal environment for unmanaged indices. If we return to normal volatility, we may return to the normal situation where managed money beats unmanaged money 2/3 of the time. Also, current strength in the market may make it tempting to park some gains in cash. Although there are periods when cash is king, over the long term, cash is always found near the bottom of returns. Investors with a long-term view should invest in long-term assets. While diversification and asset allocation help mitigate risk in a portfolio, they do not guarantee against loss. The 20-year annualized returns of available asset classes are shown in the bottom chart. It would be logical to assume that a well-diversified investor would find their own return to be somewhere in the middle of these asset classes, as their returns reflect an average between them. That isn't what we see, though. We find that the average investor has a much lower average return. In fact, at 1.9%, the average investor hasn't kept pace with inflation over the last 20 years. If they had simply held any one of these other asset classes through the good and bad times, they would have been better off than trying to time the markets. Research shows that working with experienced financial advisors can help investors be consistent, even when it's difficult, and that has helped investment results. I am always happy to review and answer questions. Disclosure charts can be a little difficult to see in a video. If you'd like to peruse them more closely to answer any questions for yourself, you can find the charts on my website. Thank you for taking time to review this information. Bear in mind that financial planning is a personal process that applies information like this to your own goals. Being informed is the first step. Let's have a conversation about your future.